Abroad then, Pratik Gupta as well. Kunal Naresh, we'll see you later on in the show and talk about what the fundamentals of the market are looking like. Pratik, hi, good morning. Good to have you on the show. Guess a little bit tentative, Pratik, right now, especially given how the market is completely focused about what the US inflation print is going to be, working with a figure of 7.9%, but who knows which way it's going to go. Having said that, Pratik, the India resilience really has outshone. But at some point, do you think we're going to align with our global peers? Or do you think this outperformance is here to stay?
Hi, good morning. I think you're absolutely right that India, while we've done extremely well, we've come out of COVID as an economy doing much better than most other emerging markets economy. If you look at our currency, our markets, they've all done extremely well. That shows the resilience of both the economy as well as the markets. Markets, I think, partly supported by very strong domestic flows. But going forward, that same thing may actually work against us at a time when, if at all, for whatever reason, there's a global risk-on rally. So perhaps, for example, there's any peaceful resolution of or some peace talks between Russia, Ukraine, there's some initiatives underway over there. Or conversely, if China, for whatever reason, in case they start reopening their economy, although it doesn't seem imminent right now, but there remains a risk that global investors have lost so much money in China. They are so underweight China. The Chinese market is now significantly cheaper than India. The gap has actually, valuation gap has increased quite dramatically. So we run the risk of money flowing out of India in case there's a risk on rally. India has done well in a risk-off environment. So that's a risk. But structurally, we remain quite positive on India from a longer-term perspective, given that our macro is still in a reasonably decent shape, whether it's the fiscal deficit. Current account deficit is high, but it's manageable. Inflation is higher than what the RBI target is, but it is trending down. And we don't think the RBI will need to hike rates as much as what the Western central banks are having to do. And growth is still reasonably robust, 6% odd, somewhere in that ballpark. And earnings growth is still in the double digits. We expect earnings growth of about 11-12% this year. And next year, it should pick up to about 16-17%. But as you pointed out, our valuations are getting on the pricier side. We are trading at 19 times FY24 earnings on the Nifty, 17 times on FY25. And I think more importantly, as I said, relative to other emerging markets globally, our valuations have really shot up. The MSCI India, for example, is now trading at 100% premium to the overall broader MSCI EM index. Historically, India has always traded at a premium, but that premium range has been usually around 40 to 60%. Now we've gone to 100%. So clearly, in the eyes of global investors, while they agree with the long-term positive view on India, but we don't see a mad scramble of people trying to invest in India aggressively at this point in time. Almost everybody seems to be waiting for a correction.
Yeah. Pratik, there's obviously a valuation re-rating, call it that, if you may, within the banking space. There is no taking away from the fact that banks are a good long-term bet and that trade is here to stay. But the point is that do you now need to look at the cheaper boys, the smaller PSBs, and are they the ones which are going to generate a higher alpha as opposed to the likes of an ICICI Bank or an SBI?
Yes, we think so. In fact, for the last few months, we have been advising investors to go down the market cap and the quality curve. Obviously, be careful. There are still some banks which are still in trouble. They haven't cleaned up their books as yet. For them, some of them, it will still take another couple of quarters. But it's worth definitely going down the quality curve and the market cap curve and taking on a bit more risk. The banking sector, in our view, is in a sort of a sweet spot wherein the worst of the credit costs are behind us. Credit costs should be coming down. Loan growth is accelerating, and rates are going up. So the loan pricing moves up faster than the deposit rate increases. So therefore, NIMs are stable to expanding. In some cases, they're beginning to come off. But by and large, it's a good environment for banks. So therefore, the larger private sector banks, they've already sort of rallied. They're already trading at 2.5-3 times price to book. But there are a lot of cheaper banks which are in the the smaller PSU banks, other than SBI, which are still at 0.6, 0.7 times price to book, as well as some of the mid-tier banks, private banks, which are at 1.2 to 1.5 times price to book. So you could see a little bit of a re-rating happening over there. But eventually, at some point in the next 1 or 2 quarters, as the valuation gap closes, then investors will need to be nimble enough to move back into the private banks, which will once again lead the rally. So, but for now, yes, I think it makes sense to go down the quality curve a bit.
All right, that's the view coming in on the entire financial or banking space. Pratik, hi, good morning. The street seems very divided when it comes to the auto sector, saying that the EV story will still take time to play out, and others saying that it seems to be quite an expensive proposition in India, perhaps might not be able to play catch up with some of the global peers. How are you looking at the supply chain constraints, the chip constraints for some of the auto players, and the EV story playing out, and how that's likely to impact the auto space?
Yeah, so I think the EV story is more likely to impact the two-wheeler space first, and that's where we are still worried about the structural changes in the industry over there. And also the demand environment for two-wheelers, as you've seen in the monthly numbers coming out, is still quite weak. We still haven't gone back to the pre-COVID levels in terms of on a CAGR basis, and also in terms of the overall industry levels. So two-wheelers is something where we're still a bit cautious. We instead prefer, maybe some of the commercial vehicle players instead, where the EV risk is a bit lower. On passenger vehicles, frankly, there's just 1 or 2 companies, and frankly, one of them, Tata Motors, for example, is not really a pure EV play, which is listed. They have EVs, but they also have a lot of other things, commercial vehicles and the global JLR business, which is very, very different and exposed to other factors other than EV. There you have risks of a global slowdown in US, Europe, perhaps even China. So that's why it's the auto space right now is a bit tricky. Valuations are not necessarily cheap. We still see the risk of more earnings downgrades. So we're a bit cautious. And the only thing I would say is within autos, the OEMs still look relatively better versus the auto ancillaries. The auto ancs, most of them are export plays, and an environment where either you have the EV risk, or where the auto ancillary is supplying to the non-EV OEM players. So then they're at risk of scaling up in the future, or you are supplying to the Western world, US, Europe in particular, where there's a very high risk of a slowdown and earnings cuts likely for FY24 and perhaps even FY25. Then the OEMs look relatively better. But within the OEM space, we prefer the CV players compared to the two-wheelers.
Okay, fair enough. That's the view coming in on the entire auto sector. What about the view when it comes to the new age tech space as well? There clearly seems to be a very different now change in commentary, with a lot of these new age tech companies taking cognizance of their profitability, pulling up their socks, if you will, which is something that the street definitely wanted to hear. What would be the outlook on the new age tech companies now? Are they on the radar?
I think we've been saying from the very beginning that these are businesses which are still in the early stages of their sort of longer term journey as a business. So many of them are still loss making and may not turn profitable at least for another 1 or 2 years, or they're profitable at the EBITDA level, but not at the net profit level. Some of them are still not generating free cash flow. They're still doing a lot of cash burn. So I think, as always, if you're investing in these businesses as an investor, one needs to keep in mind that these are higher risk investments. So you need to be prepared for volatility, and also you need to have a much longer investment time horizon. And I don't think the short-term speculation, these are not trades in our view. If you buy them, identify the good businesses and hold for the long term, and be prepared for volatility in the short term. We think while yes, there is clearly a greater focus on cash flow and cutting costs and focus on profitability, which is a good thing. That actually reduces the competitive intensity for the companies which are already who've already listed, raised capital, who are the dominant players in their respective category. it's more difficult for new competitors to enter that space. So to that extent, it's a good thing for the existing players. But in the short term, you got to watch out for pressures on the valuations from two areas. One, you have a rising interest rate environment. So most of these, if you do a DCF valuation of a stock, as the discount rate goes up, the value per share comes down. That's one. Second is as these companies start focusing on profitability, the growth prospects also slow down. So that also impacts the valuation multiples to some extent. But by and large, we think there will be some good companies emerging out of this space. As always, focus on positive unit economics, look at the addressable market opportunity, look at the moat, look at the competitive intensity. And we think some of these companies will be good, but in the short term, one has to be a bit careful.
Right.
And also not to mention that many of these new age companies which
Right.
went for an IPO, you could see potential technical overhangs from pre-IPO or pre-lockup investors coming
Correct.
out to sell. So that could
In
depress
fact,
the
that's
stock
today, isn't it,
temporarily.
Pratik? That's exactly the case that we're also seeing with Nykaa, the stock which is at the bottom of our screens for our viewers, currently down by about 2.5%. Today is the day that the lock-in is being lifted for the pre-IPO investors. I want to go back to banks with you, Pratik. We've talked about it, but I remember it was you who also made this case, said while banks will be the winners, you don't only have to do it via the private large cap banks. You had talked about the PSU banks at that time, the smaller banks. Now we've seen a run up in the PSU banks as well. You think there's more upside? Is that still your strategy, that you can look at that space, that pocket?
Like I said, in the short term, yes, I think we are in a sweet spot. Like I said, credit growth is going up. Most of the PSU banks have also seeing a decline in their credit costs, and loan growth is picking up. The main advantage which the PSU banks have is their very, very strong liability franchise, and that actually is priceless in the current tight liquidity environment. As liquidity dries up, as there's a mad scramble for deposits, the PSU banks are quite well positioned. And I think the other factor is obviously the valuation gap. Like I said, the top tier private banks are trading at 2.5, 3 times price to book, whereas these most of the PSU banks, excluding SBI, are still at 0.6 to 0.8 times price to book. So there is a valuation catch up which can happen. But this is more of a trade in our view. As the valuation gap narrows, once again, we think the risk reward becomes more attractive in favor of the large private banks. So if you're a longer term buy and hold investor, then we would still say go with the large private banks. But if you are nimble and you're willing to trade, then the smaller PSU banks look good in the current environment.
So that's when the PSU banks will start looking good for you, particularly when we talk about in the short term. Now, Pratik, we've had an earnings season, but this week what we've also talked a lot about, and maybe because of Divis, you have Cipla, Lupin. What's your call when it comes to the pharmaceutical pack?
So the pharma sector is something which we are sort of neutralish on, not particularly bullish, not particularly bearish. Basically, valuations are middling in our view. Nothing, they're not terrible. These stocks are not terribly cheap, but they're not terribly expensive also for us to get too negative on. You got sort of okayish earnings growth, and bear in mind you still have the continuing pressure on the US generic space from competition over there, and the companies which have exposure to the domestic pharma spaces, they're growing okay. So pharma, we are sort of less bullish. We are actually, if you're looking at pharma, we are actually advising investors to look at the healthcare space instead, which in our view, longer term looks far more attractive. The hospital space in particular, I'm not talking of the diagnostics, but more about the listed private hospitals, where the headline multiples are higher, but the longer term growth prospects are much higher. These companies, the policy framework is likely to be supportive in our view. And unlike the pharma companies where there's uncertainty about US FDA inspections or more competitive intensity in the US or other Western markets, slowdown over there, etc. The hospital space is purely a domestic story, much better longer term growth prospects, the number of hospital beds that we have as a country are still very, very low. So the well-run, well-managed hospitals, they can deliver superior ROEs and ROCs over the next few years. So these stocks are more expensive, but we generally, at current valuations, we prefer the hospital space versus the pharma space.
Right. Pratik, great to have you on the show. Thank you so much for discussing markets and, of course, various sectors as well with us.
Sure. Thank you.
Okay, let's just revisit the market while we